Mark, thank you very much for joining us.
It's a pleasure.
If we could go right back to the beginning of your time at Templeton and the influence that Sir John Templeton had on your investment philosophy.
Oh, he was quite a pioneer in many ways and a real inspiration, because he was one of the first investment managers in the U.S., in fact, all over the world, to think globally, to say, look, if you want good performance, you've got to look globally, because no one market will be the best performing over many years. The other thing that he inspired us was the long-term view. He said that you must take a long view, because everyone else is taking a short view. So you've got to take a long-term view. And you've got to do things different from what other people are doing. If you want to outperform the index or what other people are doing, then you've got to be different. So he was very inspirational.
When you say long view, can you give us a time horizon there? I know generally as value investors, you look at 5 years.
Yes, we look at the 5-year earnings projections, and also the balance sheet and cash flow of companies. We look back 5 years as well. But the reality is that we look further than that. Once we get invested in a company, we may hold the company for 20 years. In fact, we have one company that we've had for 22 years. So we take a long view.
You recently launched a blog, and you have got investment advice on that blog. And I noticed that a Hong Kong graduate recently said to you, how do I become really, really successful in the financial markets? And you are, in the last 20 years, one of the most successful emerging market fund managers. So what advice did you dispense there?
Well, thank you very much. The first thing is that you've got to be humble. I mean, a lot of people introduce me as being a guru and so forth, and I put that aside very quickly, because you're as good as your last performance, and every day is a challenge. So I think the first secret is to be humble, humility. You've got to be willing to accept your mistakes, to admit them, and to move on. The second thing, I think, is you've got to be curious. You've got to be willing to learn, which goes along with being humble. In other words, you've got to be willing to take information in, digest it rationally and objectively, and then apply it to what you're doing. So I'm a perennial student, you know, I'm constantly learning. And then the third thing is that you've got to be patient. You've got to be willing to wait for results, because results will not come overnight. And if you talk to some of the wealthiest people in the world, you'll see that many times their wealth came as a result of many, many years of hard work.
Mark, have you made mistakes?
Oh,
along
yes.
the way?
We've made many mistakes. I've made many mistakes, and we continue to make mistakes because the world changes, and very often you miss things, which, by the way, is another very important factor, and that is being diversified, because you cannot see everything all the time. There will be events, sudden events, which are unexpected and cannot be predicted. Therefore, you've got to be diversified, so that if one thing goes wrong here, the other thing may not be going wrong, and you will be saved. Your portfolio will be intact. So diversification is a very important safety mechanism.
Well, let's pause there for a moment. The diversification strategy across emerging markets, if we look at your exposure across Brazil, China, India, what's Brazil, Russia, China, India, isn't it in that order? That's
right. Currently in our global portfolios, Brazil is the biggest, followed by Russia, then China, then India. And then, of course, we have South Africa, we have Turkey, we have Poland in our portfolios, and we have many other countries, of course. Thailand is very big in our portfolios.
Latin America, the opportunity there, it's certainly one of the more celebrated emerging markets. Is it for you a high growth area, given the fact that it's your largest exposure?
It's a high growth area, but not as fast growing as China and India. As you know, China and India are growing anywhere between 7 to 9%, whereas in Latin America, the norm is 4 or 5%. But they are beginning to accelerate, and that is the promise for that area of the world. The interesting thing about Latin America is that although on a country basis they may not be growing as fast as countries in Asia, but on an individual company basis they're growing very fast, and they're becoming global in their scope. For example, Vale do Rio Doce, the biggest iron ore producer in Latin America, is now in Mozambique. they're in other parts of the world, and they're being quite successful in doing that.
Looking at China, there are those detractors who say that the economy is overheating, and certainly that the inventory rebuild scenario has played a role in artificially boosting commodity prices. Your view is China intact, and does the next decade belong to China?
I do believe the next decade belongs not only to China but also to India and other countries in the world like Brazil, who are grasping the opportunities and really on a growth path, and being conservative about that, by the way. You can grow without taking too many risks. You can also be quite successful, and that's what's happening in many of these countries. But I would say that if you look at China, you must look at China in many different parts, because it's a huge country. They've got different provinces. There's high growth in one place, low growth in another place. Bubble kind of activity in one area and not in the other area. But overall, I would say that the government in China has been very clever in avoiding bubble type scenarios. They've withdrawn money from the market, from individual areas, if they think a bubble is forming. So in many cases, there's oversupply in a number of arenas, which means that actually prices are falling, not rising. And a bubble, of course, means that prices are going out of sight and a lot of irrational activity is taking place. I don't think that's the case.